Well, Income Asset Management has recently partnered with BondAdviser, enabling clients to directly hold a bespoke portfolio of bonds that will be managed by BondAdviser's team. Let's get across the detail. Jenna Hayes is joining us from Income Asset Management and Charlie Callan from BondAdviser. Welcome to both of you. Good to have you in the studio. This is unusual, but welcome.
Thanks, Andrew.
Let's first look at the broader picture of what we're seeing at the moment, Jenna, in terms of the latest in bond issuance.
Yes, well, this week was very exciting. For the first time since APRA announced the phase out of AT1s by Australian banks at the end of last year, we had UBS come to the market with an Aussie dollar AT1. So this was a 5-year callable instrument paying a fixed coupon of around 6.4%. It was incredibly well received, unsurprisingly, for a few reasons. I think firstly, UBS, a great reputation, unblemished track record in terms of calling at the first opportunity. But also, I think really importantly for investors, it wasn't the write-off only format of the Credit Suisse AT1 instruments that you might recall. This was convertible to equity. So they had around an $8 billion order book, printed $1 billion. So we're certainly hoping that we'll see other issuers follow suit.
How is that issuance in terms of the broader cycle we're seeing?
Well, I think one thing that I really liked about it was actually probably the last time I was on studio, we might have been talking about the recent 20-year bonds by ANZ and Electricity of France, and they're good opportunities for clients that are looking to lock in that 6% yield from an investment grade issuer. But at the same time, while you do want an allocation to that within a portfolio, you don't want a portfolio of just kind of long duration assets because you're going to be heavily sensitive to moves in rates. And so this also allowed clients to lock in that 6% level, which is a psychological level and a good target for a lot of investors in terms of their yield requirements. But at the same time, without extending tenor, they were able to do it by going down the capital structure with an issuer that we really like. And UBS fits the bill. It's a globally systemically important bank, very strong track record in terms of calling.
It's notable too that the French are finding this market attractive too, aren't they?
Absolutely. Yeah.
Why is that?
So there's some complexities from a foreign currency hedging side of things that's making kangaroo issuance attractive. But the way that we're liking to think about the market presently is that it's firing on all cylinders. So the credit spread is very low from an issuer perspective, so they're paying less from a cost of capital perspective. But the yield is still all in attractive to the investors. So you're getting a lot of participation from the issuers, but also from the investors, and that really sees the market hum along when it's working. They're all singing in one tune.
Well, let's get to what you guys have come up with. So BondAdviser partnering with IAM, coming up with managed discretionary accounts. How does that actually work?
Yep, so a managed discretionary account is a little bit different to a unit trust, for instance. So in a unit trust, which is what most bond funds, or how most bond funds are structured, what you will receive is a unit of a fund. You don't actually own the assets directly. With an MDA, what that allows you to do is get the best of both worlds with respect to doing it yourself and owning bonds directly. And the other side of the coin is having professional management, active management, someone there looking after your interests. And so the MDA that we're excited to launch with IAM enables investors to receive the benefit of our independence and our active management capabilities, but also via the IAM platform, own these bonds directly in the client's name. And that's a really compelling opportunity for investors that want to own these assets directly.
All right, so Jenna, what are you saying to clients then looking for that access to bonds? Why is this MDA solution a good way to do it?
Well, there's definitely a lot of funds and ETFs out there, but as Charlie mentioned, one of the real benefits of this is that it is that direct ownership. And so along with that, you get the transparency, you get a more kind of regular and predictable income stream from the coupon payments. You also have more liquidity in terms of just secondary market trading. But Charlie touched on a really good point, which is also that active management. And so it's really, with fixed income, it does pay to be active because there is going to be, dislocation at times. Even at the moment, you mentioned the French issuance. So given the political uncertainty in France, that's seen some pressure on some of those French bonds. That's an opportunity. Earlier this year, of course, there was volatility around Liberation Day, and that presented clients with an opportunity to make money. And so you do want to empower your portfolio manager, in this instance BondAdviser, with the ability to respond to the macro environment, to respond to credit spreads. And even, we look as recently as yesterday, we had the release of the monthly CPI data, and now the market really is repricing the outlook for rate cuts, and it's moved from November being looked at as probable to well into next year. And so it's good if you've got a portfolio manager that can adjust the portfolio as required.
Yeah, how has that changed the outlook? Because in fact now it looks as though just one more cut being priced in at the moment.
Yeah, exactly. And I think it was also quite interesting because that monthly CPI print is, often kind of overlooked as being monthly. And so I think it really did surprise a lot in the market to see, the banks in the market move out the outlook for rates. And also because on the headline number, it didn't actually look like a big beat, but it really was in the detail.
So, sorry, Charlie, go on.
I was going to say, we still think November's on the cards
Okay.
in terms of a cut. So as Jenna alluded to, the monthly print is actually not a preferred measure from the RBA's perspective to look at. And one of the things that the market, I think, missed recently is the RBA came out with its historical revisions to the neutral rate. So that's a little bit complicated, but the neutral rate is the interest rate set by the RBA where the cash rate has no net impact on the economy. So it's a hypothetical rate. It's very difficult, near impossible to know. But the revision to this rate was quite significant and actually suggests that the RBA needs to continue its rate cutting cycle to move to a more neutral level, which is actually what they're trying to do right now. So even though this monthly data point is suggestive that rate cuts would be pushed into next year, we actually think the RBA will overlook that signal, as they've overlooked this data point plenty of times in the past. And in fact, their internal team is saying you need to cut more faster to enable a more neutral level of interest rate policy.
So given all that, with that background, let's return to, in terms of that direct bond MDA solutions, and Jenny, you mentioned obviously the hybrids being phased out, the AT1s. Charlie, does that provide perhaps an opportunity here then for what you're offering?
Yeah, definitely. So I mean, everyone's thinking about how can they replace hybrids. So it's a $40 billion market that's rolling off over a sort of steady cadence out until sort of circa 2032-ish. And there's plenty of different ways to skin the proverbial cat in terms of receiving your income. But for those that want, as we alluded to, transparency, active management, actually putting in guardrails of what you want, so building an actual bespoke portfolio to you. So whether you set issuer concentration limits, exclusions on issuers from an ESG perspective, or tenor limits, or anything like that, it can be embedded into your own investment program, which makes it a really unique solution to you as compared to if you're having to go out and purchase an ETF on the market, you're paying for the cost of beta, and it's not a custom solution to you. So we've advised clients plenty of times in the past as to how you can try and get an alternative hybrid-like return stream. And one of the things that we've said in the past is if you think about replicating a third of bank senior, a third of bank tier 2, and then either a third of bank equity or private credit or something like that, you get a similar kind of income stream. But having an MDA portfolio allows you to diversify away from the banks. So Australians, generally speaking, are very overweight the banking sector locally, whether they realise it or not, via their superannuation, via their shares, via their mortgage, all these kinds of things, real estate markets, all tied up into the banks. So an MDA enabling you to get access to the non-financial corporate bond market, for instance, is actually a really strong diversifier. And it's one of the things that we've been talking about more broadly recently, which is diversification is always great, but at the moment it seems really important given where asset prices are.
And is that what you're finding with your clients too after that diversification at the moment?
Yeah, we've spoken about it before, just the equity risk premium and the fact that at the moment you're not really getting paid if you've got fresh capital that you're looking to deploy for buying equities at these levels. And so with bonds, although the credit spreads are tight, we think compared to other asset classes, we're still seeing compelling value.
Well, great to get across that partnership you guys have come up with. Charlie, thanks for joining us on BondAdviser, and Jenna from IAM.
Thank you.
Thanks, Andrew.